Hello, folks. Welcome back. Today is September 17th, 2025. Okay, and tonight's lecture is going to be on trading FOMC two-stage delivery. All right, so we're looking at the NASDAQ. We rolled over to December contract. In case you haven't noticed, the, the volume, open interest has increased to the degree that December is now higher and more active. All right, so we're looking at on the left-hand side, it's the daily chart for December contract of NASDAQ futures here. And then over here, we have a 1 minute candlestick chart for the same. Okay. And this handsome devil here, he's got his eye on you. Okay. So for the folks that may want to ask, no, I'm not going to remove that because it's simply a matter of piracy. People take my stuff and pretend it's theirs. So this way, there's only one of me. Okay. So the concepts I went over last night as it regards to trading all-time highs or near all-time highs is to constantly look at very specific price points, volume balance, fair value gaps, the opens, closes, and try to avoid trying to pick the top. Now, it doesn't mean that once you're seasoned as a analyst that you can't look for shorts, but they have to be intraday. But the larger scale price runs are going to be more apt to be in line with going higher because it's impossible to pick the top. Okay, and anyone that tells you that they figured it out, they're lying. Right. So by looking at the intraday chart here, notice that this high and this high are relatively equal. And if you go back to the left a little bit more over here as well. And I'll counsel you to look at the open and close of yesterday's candle on the daily chart. Mark that out and you'll see that that's very close to running out these relative equal highs. And that's what we have here at 9:30. We have a run up and it breaks lower. So we have a shift in market structure. And this is enough to indicate a shift in market structure bearishly. And then another swing low here. Then we have relative equal lows, which we'll look at as minor sell side. And then we have a sell side liquidity pool here. Now, I'm going to show you by looking at where this sell side liquidity pool is in deference to this range here, this single up close candle on Monday. So we're going to look at where this is in proximity to this range between this candlestick's low, this candlestick's high, and why it's more likely to come back down into this volume imbalance and this fair value gap. Now, before I get any further, I did some trades today, and I shorted in the morning here. I'll go over this, and then I shorted once more in the afternoon at the FOMC, just using the model 2022. So it's not complicated. It's not Goldbach. I know I have a student of mine that insists that that's what it is, and he's convinced other people that's what it is. I swear to you in Jesus' name, it's not Goldbach. Okay, so if you want to believe I'm telling you something that's not true, then run with it. Okay, but I'm honestly telling you what I'm doing and what I teach and what I trade with has absolutely nothing to do with Goldbach, and no, it's not Enigma. Okay, so buy side liquidity pool here. We run up at 9:30 opening, and then we break lower, and then you know the drill for 2022's model. We run the fib from the high to low. We look for it to trade to a premium. That means it's got to go above 50%. Ideally, you can see a convergence with the standard flagship pattern of my channel, which was for a long time the optimal trade entry, which is simply just a 3/4 pullback in a impulsive price leg like this, and then running up higher into this small little inefficiency right there. So we're going to look at a lot of these things in a moment in greater detail, but for now, let's start fleshing out this lower time frame in relationship to that daily chart as well. So here's the buy side liquidity pool. And here is the buy side imbalance, sell side inefficiency, BISI, which is a bullish fair value gap. So we always want to grade that price swing, but keep your eye on this candlestick's low right here. I had that noted with that short little trend line. That is this line right here. So that way we don't lose track of where we're at. And then this line right here on the daily chart is this level down here. So there are 3 blue lines on the 1-minute chart, but it's only 2 on the daily. So the upper one here is just simply the buy side liquidity pool at 24,528.5. These lower 2 are in reference to this buy side imbalance, sell side inefficiency. All right, so we grade it. So the lower quadrant, consequent encroachment midpoint, upper quadrant, and then the levels itself. That being, here's the high of the daily BISI, upper quadrant, consequent encroachment midpoint, lower quadrant, and then the low. And then the sell side liquidity pool here, and then the first presented fair value gap after 9:30 a.m. Eastern time. So that small little inefficiency, we'll zoom in a moment. You can see why I have it outlined as I have it here. And then we have a smaller minor side liquidity pool there. So running up, taking buy side, and then dropping down, sell side liquidity pool here taken. And then notice what they did. They took it to this low and left that there. And then it rallied back up. This is classic model 2022. When it leaves larger intermediate term relative equal lows, this is a smaller minor relative equal low in relationship to that low and that low. So in other words, it goes down, then rallies back up. This sell side liquidity pool here with this low here is unfinished business. Okay. I'll have chapters in the 3 books coming that I'll touch on. Each volume I'll have more to say about unfinished business. But the idea is the market rallies up, leaving the sell side or sell stops here intact, rallying up, which is a false hope rally for bulls. And it goes up into first presented fair value gap and then sells off and careens down through the sell side liquidity pool and goes right to consequent encroachment of the daily buy side imbalance, sell side inefficiency. So look at that price right here in the green, 24,447.5. That's what this is here, 24,447.5. It hits it right there. Then comes right back up to the upper quadrant at 24,473.25, and then hits it dead on right there and then sells off once more, goes lower to the lower quadrant. These quadrants and my inefficiencies that I place emphasis on from the higher time frames down lower time frames, I grade all of them. And they're more sensitive. They're more accurate than things like common floor pivots, um, simple support and resistance ideas, which is absolutely, left to the device of the user. It's so subjective. It's absolutely ridiculous to consider that while the idea of support and resistance is beneficial for someone that's brand new, because you want to see how prices bounce at specific levels and reject at specific levels above it. But it's not as easy as simply saying, well, it's this high and that low. Because as soon as you try to use it and try to think like that, and the market's just going to go right on through it. So that's why I've created these concepts where it's very, very specific because it gets in sync with the algorithm that doesn't exist, right? So we're going to move the chart over a little bit in time. And you can clearly see now here, see that little volume imbalance right there? Separation between this candlestick's open and that candlestick's close. Then we have a small little volume imbalance there as well. And that's why I'm not using this little segment right here, which you probably saw in your chart thinking that that might be it. But you always have to include the volume imbalance because the algorithm is going to refer to that as well. So the market drops down, sweeps into the consequent encroachment of the daily BISI here, and then rallies back up, hits it dead bang on the upper quadrant. That's this line right here. So what we're looking at it going down to this level here, and all the move from that point down here So in other words, from this green line down to this low, this hasn't happened yet right here. So we hit the upper quadrant, we break down the consequent encroachment, break lower, come back to consequent encroachment as resistance. So this is a premium sensitivity, drops lower, lower quadrant, lower, and then comes back up. Now failure at consequent encroachment, breaks lower, premium sensitivity at 24,421 and a half. And then finally we get up to, or down to rather, this candlestick's high here. So that's this level. That blue line is this blue line here, indicating that high right there. So last Friday's high. From this high down to that low, running a fib on it, what I'm highlighting here is the 79% and 62% retracement level. So this is optimal trade entry here. And it overlaps. Look at our body stop inside of the first presented fair value gap. But it's also halfway point 70.5, that little sweet spot I taught on the optimal trade entry. Hits that and breaks lower. Comes right back up into a small little gap right in here. We'll look at that in a minute. Trades right up into it there, slams into it, and it also keep cutting through. Look at that. You see that? That's beautiful. This is venom. So we have a convergence of fair value gap and venom because we have this pass through on the upside, this pass through on the downside. So it can appear just like that. And it isolates all this price action right here. So it hits it and then moves lower. Nice little sell side imbalance, buy side inefficiency here, comes right back up, hits the consequent encroachment, sells off, and then hits the low of that inefficiency. That in and of itself is enough for the morning session. You can hold for lower, but it's FOMC day. So you want to be very surgical about what you're looking for. Get in, get out. So you can see that premium sensitivity as indicated here, and it went much more lower than that of the sell side liquidity pools that we highlighted on just a 1 minute chart. So it's important by having the levels that's indicated as I taught last night in lecture trading with all-time highs or around all-time highs. It's really important that you take your inefficiencies and you grade them and transpose those levels onto your lower time frames. And you'll start to see setups that were just always there, but you never noticed them before. All right, so now I highlighted this level here purple. You can see it's now discount sensitivity, and that's what this is here. So this purple line is this purple line here. So that way we can track it. And now I'm zoomed in on the daily chart over here so I can see a little bit more detail. And right down here, this is a volume imbalance. And if you watch the trade example I did today, because I was watching it and I was keyed up about the FOMC announcement activity and the volatility that was created, I miscalled this as a fair value gap, and it's a volume imbalance is what I was referring to. This is a fair value gap, but then this down here is a volume imbalance. So it was quicker and easier for me to say FVG in the typing while the trade was open, but to correct myself, that way I know some of you are probably thinking it's a volume imbalance. And if that's what you thought, you're correct. But I'm out there going live, and you just can't do everything perfect when you're trading. You're concentrating on it, and it's during FOMC, and you're trying to teach and you're trying to type. It's a whole lot of stuff going on. It's not as easy as it looks. All right, so and then we have this premium wick. I graded that. So when you see these levels over here, that level right there, 24,384.75, that's this level right here. So it's the upper quadrant of this premium wick. A premium wick is any wick above a candle, and this is a discount wick, any wick that's below the candlestick body. Okay, so put that in your notes. And now I am grading the fair value gap here, but including the volume imbalance to that low. Okay, and you can't see those levels here because it's below. Now scrubbing over more into the day, now into the PM session, we can see the sensitivity around that 24,384.75 level, which is this one here. So at this moment, price has done at 12:45, it's trading right in here. And just, I'm sorry, right here. It's trading right here. And it's just fallen um, just above the consequent encouragement level right there. And again, this portion of the day had not been delivered yet. So we're right about here at 12:45. Then we come back up. We find discount sensitivity here at the upper quadrant there. Now it's going to trade back up to this level here, that blue line. That's this blue line right here. And it's easy to track it by saying 24,400, 24,390, 24,400, and then 390s between these two prices. So that's what this blue line is here. So that's how you want to be navigating. And when you're journaling, I'm actually doing the charting, all the annotations for you. That's the benefit of this little soiree together, going into the holidays. You're encouraged to print the PDF out or type over them with your additional annotations, things that are pertinent to you. So I leave lots of empty space. That's why I've been doing it this way, because it gives you room to type in here or write by hand. All this area over here, you can write in there and draw special attention to things that I may not have drawn that much attention to, but you have seen it and it means something to you. All right, and then the 2 o'clock hour, I've delineated that, and I've extended the first percent of fair value gap here into the afternoon. It's something I teach, and 2 o'clock is now here. Price trades up into the first percent of fair value gap post 2 p.m. So the market breaks lower. We have a fair value gap that's formed here. We trade down into the upper quadrant of the fair value gap here between this candlestick's close and this candlestick's low. That quadrant, upper quadrant level at 24,297.75, that's this level right here. It trades down to it there and then rallies all the way back up to this little gap right there. So again, all this is high to low, 3/4 pullback, optimal trade entry, fair value gap, model 2022. Unfinished business, and then unfinished business down here in the volume imbalance. So the market trade up here. You watch me get stopped out on that run in here, and then it breaks lower and finally gets into the volume imbalance. You can find that little snippet, that little vignette of the trade on my X account on what used to be called Twitter. It's sped up. This is a small little piece of it, but you actually see me not get my objective, and I end up getting stopped out. I trail the stop loss, but in all this price action here, I thought that we had enough to protect the short, but it came back up, snagged, and then down, got it here. And rallies up, sensitivity here on that same level there. So once it dropped down to the volume imbalance on the daily chart here, there, then it's going to do the second stage of delivery of FOMC. And I'll show you in a second what that means. But here's 2:30. Usually there's another wave of price action that begins at 2:30. And whatever the high or the low is, usually it'll run for it. But it first dropped down, sticking true to form and the things I talked about last night. It went down to a severe, deep discount into that volume imbalance, and then rallied all the way back up, straight shot, no pullbacks, high, relative equal, comes back down, lower quadrant, that's here, of this fair value gap. And you're going to want to watch this video a few times and also look at the charts in your own platform and compare and contrast, and you'll see what it's doing here. But if you don't have your journal with multiple time frames like this, at minimum, what the daily chart's doing and your trading time frame, you're not going to see what it is that you're trying to learn. You're obscuring your ability to follow along with price action. But it then rallies up, consequent encouragement, upper quadrant, and then sends it through first presents fair value gap and the relative equal highs here. So that initial intraday daily high here earlier in the day, they take that out, and then we start to consolidate in between the quadrant levels and first presented fair value gap. This is the first stage delivery where it sells off at 2 p.m., beginning of FOMC, and then during the conference portion. And Powell tends to be a little bit like me. He likes to talk more than most people want to listen to. So it kind of like delays it a little bit. And then here we have it there, and then all the way back up there, taking out the buy side. And then in consolidation, then basically is untradeable. And this is the second stage here from the low up to the buy side, running the high out of the day. But look at this run here. That right there, you wouldn't expect something like that had you not listened to the lecture I gave you last night. And for all you FX, Forex freaks out there, this is the daily on dollar index. And dollar, admittedly, has been basically trash. Okay. It's unfortunate. It's waiting for its digital version to be forced upon us. So what I've done here is I've watched the low get taken out there, and then we're retracing back up into this sell side imbalance, buy side inefficiency, volume imbalance, and to that candlestick's body, because there's a small little separation between here too. So that's what I'm showing here. And the market trades right back up to consequent encroachment of that inefficiency. Until we get above this and we ignore the lower half of it and start building PD arrays that are bullish, I'm bearish on dollar. Until we do this very thing here where we use this as constructive discount arrays and then building new bullish discount arrays that and shows price respecting it and going higher and starts tearing into these highs without rejection, I'm staying bearish on dollar. It can stay in a consolidation still like it's been for months, but I'm not bullish on dollar. Let's just say it that way. But they took us all the way down like this severely at 2 o'clock, and then basically nothing that was worthwhile taking a trade on. I mean, I don't trade the dollar index. It's used as a barometer. It helps me determine the opposite direction for euro and cable and any other dollar pair or cross. And here's a euro. And you go out to a weekly chart. And I want to say I talked about these levels here when I was talking about euro, but I can't remember, admittedly, if I was talking to my private students or if it was something I said in a video or something I'd done on X. But I know I talked about these two relative equal highs here, and I simply just don't remember where I said it. So I just wanted to put that out there, but it doesn't matter. This is where it went to. It reached up into that level there at 1.19087. That's this level here. And it was basically a really, really tight consolidation and straight shot right at 2 o'clock. They rammed it up there, first stage, and then rejection after taking the relative equal highs here on the weekly chart, dropped it out, fell out. And then this little area right here is the only thing that I would have considered tradable on euro. And all that would have been was using the fair value gap here just to take out that low. As soon as it would have went below that low, I would have been out. I would not have been holding on to it lower. And that's the only thing I would have done with the euro dollar. Now, this is a 5-minute chart. So, you got to take that for what it's worth. Admittedly, euro and fiber, or I'm sorry, euro and fiber are the same thing. I'm thinking cable. I haven't talked about Forex in a while, a little rusty. GBP USD or cable and fiber, which is Euro USD, those two currencies have been a little sloppy. I mean, if you're in the really, really smaller time frames, less than 1 minute, I mean, there's scalps there you can take, but it's just been really not very favorable, which is why I haven't talked much about it. But I will ring in euro dollar. I will talk about cable and maybe other crosses, maybe some exotics, like the beast or something like that, euro yen. I don't like the yen crosses, but I know a lot of you guys are interested in looking at it and having my opinion about them. So I'll share it when it's pertinent. But for right now, that's going to do it for tonight. Thank you for your continued interest. I hope you found this insightful tonight. And so I'll talk to you next time. I wish you good luck and good trading.